Hi. Let's bring in Ryan Lamond, co-founder and CEO of NeoVision Wealth Management. Ryan, thanks so much for joining us. Let's just start with some of the focus that we're seeing for investors right now. There is a broader concern around some of the AI spend, which we saw really contribute to a lot of choppiness last week. You describe this current phase for markets as sort of a punishment phase. Can you explain where we're at right now and sort of how that's feeding into your own sentiment at the moment?
Absolutely, Jennifer. So just to give you some numbers, last month, the month of May, I have personally consumed 200 million tokens with my AI provider. I've paid $200 that month for my subscription. So the difference between the $5,000 of the consumed tokens, because 200 million tokens could cost $5,000. The difference between the $5,000 and the $200, the $4,800, is basically fueled and financed by VCs and by hyperscalers. If you look at the free cash flow difference between how much hyperscalers have made in free cash flow and how much they've consumed and spent on AI companies, it is negative today. So this is why today markets are punishing hyperscalers for this free cash flow consumption. These hyperscalers were profitable and interesting as an investment thanks to their free cash flow generation. But today they're consuming a lot of money into what I call a subsidy system, which is the difference between $5,000 and $200. And this subsidy system cannot continue for very long.
So do we continue to see a punishment, as you describe it, Ryan, across the board, broadly speaking? We were talking about what we're seeing in Asia, a bit of a rotation right now, as Winnie was describing it. What's your expectation for how long this will continue?
I think the rest of the year will be very choppy, up and down, especially that most of the positions that have been taken, the new ones, are by retail, and they're mostly leveraged positions using leveraged ETFs. And we've seen it in South Korea. South Korea is an exemplary market to look at it, where a lot of leveraged positions have come in through retail, and this is where the chop we're seeing, limit down, limit up, on a continuous basis. The US market is much broader, much bigger, so we see this effect in a much lesser way, but I think we will continue to be volatile until the end of the year, until an accident happens. So one of these AI companies shows serious weakness or fails, or until something changes.
So then where do you position, Ryan, just given some of the uncertainty right now? We mentioned we're at the end of the quarter. Where are you focusing in as you're speaking to clients?
This is the heart of the question. So we are institutional investors. We invest on behalf of clients. I have a lot of difficulty sitting in front of a client and justifying investing into the S&P 500 versus, for example, the Swiss index. Let's look at both. The Swiss index has gone up over the past 12 months by 19.5%. The S&P 500 over the past 12 months has gone up by 19.34%, which is exactly the same thing. One is very speculative, driven by leverage positions, by a technology that is yet to prove itself, prove its profitability, versus another market, which is chocolates, medicine, and very traditional sectors where people will continue to eat chocolate and will continue to buy medicine. So I have a lot of difficulty justifying one market over the other. So yes, we are, for example, in Swiss equities that have performed as good as the S&P 500. We're in gold as well. If you look at gold over 1 year, it has gone up by roughly 25%. That's more than the S&P 500. Over 2 years, gold has gone up by more than 70%, which is the double of the S&P 500 performance. We haven't done that well in Chinese equities, for example, but we continue to build positions because we believe we'll come back. And we are into emerging markets like Brazil, for example, that has a trade surplus.
And we are seeing gold marginally down right now, but still above $4,000. So still tactically positioned right now. Ryan Lamond, we have to leave it there with you, but appreciate you joining us, co-founder and CEO of